So in the second part, Raman, I would like you to cover how have you applied AI and machine learning in fund management, and thereby what is the investment philosophy of AcuraCap as a product of your experience and application of AI and machine learning. You have to unmute. You're on mute.
Okay. Yes, I did. Thank you. There's a little bit of lag, Kamal, I think. You can hear me now?
Yes, I can hear you. Absolutely. Clearly, I can hear you.
Okay, good. So just to give a little sense of the background here, I'm a computer scientist by background, and this journey actually started almost after 20 years of doing only tech work, right? This was in 2007 that I started to feel that, despite having picked some of the best fund managers and advisors for my own personal fund, the returns that I was experiencing were kind of okay, but not so impressive. And the thought came to mind that perhaps because I had the background of both technology and finance, I could probably do a slightly better job myself. And that's the genesis of what eventually became AcuraCap. Me and my partner in AcuraCap, who was also a colleague at Adobe, both of us were on the board of Adobe and um, doing some stuff there. We set AcuraCap up more as a family office, looked around the world to see what was being done there in terms of technology, came across work of some very, I would say, impressive fund managers, including the likes of Joel Greenblatt, who ran the Gotham Fund, looked at other tech strategies, figured out there wasn't enough data in India to do a real AI at that time, etc. But long story short, over the last 10 years, we've been able to do a little bit of progress. We were able to set up an AI-based model primarily to manage our own money. And then as it started to do well, it started to get noticed. Starting 2011, it became from a family office a fund of its own. Uh, it's got a modest corpus of about 1,000 odd crores and some AIF stuff as well. So it's primarily in PMS format and AIF. About half the corpus is still our own. The other half is of folks who came to know about us and started to sort of co-participate and invest. The returns, I would say, have been reasonably satisfying. In fact, I could probably share okay. So if you look at the returns, and these are starting late 2011, that's when it became a sort of a fund from a family office. What you see here is the PMS schemes in the top table. Two of these existed starting 2011. The others came later as we progressed. And then the AIFs that we launched about 18 months ago. Okay. What you see is for every time frame that one would be interested in, each one of our schemes corresponding to every benchmark, right? So Alpha 10 is a large cap, so compared to BSE 100 and a few other mutual funds for reference. Picopar is a small cap compared to indices, the small cap and small cap funds and so on and so forth, as well as our AIFs. Each scheme, each strategy has beaten the corresponding index by a fair margin, and most of the peers and other funds too. So to that extent, I would say the original goal of being able to beat the market and do better than a professional fund manager has been achieved. Obviously, we've seen ups and downs. We saw some fantastic years, including 2014 and 2017. In 2014, we experienced a calendar year return of 102% with Picopar, with our small cap. Again, experienced a 60% plus in 2017 and so on and so forth. But we also experienced a 2018 down time where we did as badly as the market. So it's been an interesting journey for us. What we've done is used a form of AI which is appropriate for the amount of data that's available. So rather than using neural or deep learning, we used a lot more of linear regression and fuzzy logic and stuff like that. Because for the amount of data that we had, it wasn't possible to train a layer of neurons, deeply enough to make productive output. What I've also done over the last few months is applied the same data or applied the same neural strategies to US market, because that's where a lot of data is. And this is which we recently launched a fund which essentially takes money from Indian resident investors under the LRS and is able to invest that money in the US market with the goal of beating S&P 500. Our back testing suggests that we've been able to do that quite well. Okay. It's just launched, so we are going to start to deploy funds soon. But there again, the framework is AI that takes care of growth, quality, valuation, and momentum. It also offers a fixed income strategy for the US. Now, this is in addition to the schemes that I was talking about earlier for the domestic, which is the PMS and the AIF. In addition, we've, for the last few years, advised a US pension fund that deployed about $60 million. So we've been able to clearly see benefits of applying AI to various markets, various asset classes, etc. But the one which is closest to my heart is this new initiative. If you recall, towards the last few slides, I was talking about the need or the right time to disrupt the advisory and the wealth management with technology. I think that time has come. And there's been a lot of IP that we've created, that I've worked on over the last 12 months, from strategic allocation to tactical allocation to advisory, the real advisory stuff, right? Portfolio formulation, etc. And I believe we are probably, you'll see an offering and a truly pure blue, a true blue, AI-based advisory kind of a service coming out of this IP over the next 6 months is my sense, right? I think that's what I'm most excited about. So overall, we've had some fairly interesting and fruitful experiences with AI in India and now in US over the last 10 years.
Right. Thank you so much. So, coming to the more practical part of our session, what are your market views and what are your sectoral views? What is machine learning and artificial intelligence telling you in this regards?
So, first of all, the right question to ask is not what my views are, but what the machine's views are, right? For me, my views don't matter, the machine's views matter, right? That's where we are a little different. Let me step back a little bit and go back to January of the year, right? Beginning of the year, actually even September of last year. What was the machine telling us then? No one was obviously aware of Corona or COVID in September 2019. Maybe a few folks in China were, but beyond that, no one was, right? And it was clearly not public information at the time. The model, therefore, obviously, or us, therefore, had no way of knowing that the pharma sector should be doing well, right? Which happened to be the best performer. But if you look at what our model picked in September 2019, not on the basis of having seen that Corona or COVID is going to strike us, but more on the basis of what the numbers were telling it, that pharma after a long time was going to get extremely attractive. So by the time we hit the turbulent period of the first quarter, right, the Jan, Feb, March calendar quarter I'm talking about, we were loaded with pharma and FMCG. And if you see the last 6 months, our funds have outperformed the index by 17, 18, 20%. That's a huge outperformance for a 6-month period, right? Where basically our large cap didn't budge or didn't fall, almost nothing, right? When the market was taking that big beating, primarily because a lot of it was in pharma, in FMCG and other defensive stocks. In COVID or no COVID, the model had already sensed a very distinct slowdown that had already built up. And it was starting to see that the businesses which were strong in balance sheets, which had more resilient business models, which had margins which were reasonably better protected, which has less competitive intensity, and the model has different ways of finding that out, right? Both fast frequency numbers as well as fundamentals, everything that's on the P&L and balance sheet, but then also macros. It kind of read that barring these businesses, the other businesses were going to be in trouble. By the way, it also had a big piece of Reliance at the time with it. Obviously, not fully necessarily, or actually at all knowing what was going to happen to Jio's valuation, right? Long story short, what I'm saying is I feel that a lot of times things happen because they have to happen based on numbers. And then we as market participants, in hindsight, give it some justification or some explanation. Markets just looking for an excuse for something that would have anyway happened. So whether or not Corona had happened, given the run up, given the valuations, given the slowdown in the economy, the pressure on the earnings, given the interest rates where they were at that time, it was already suggesting to us that it was an overheated for especially for cyclicals and sort of those kind of businesses, right? Fast forward to March, right? The model was again looking at data, again looking at the relative valuation of small caps and large caps. You know how big a beating small caps had taken by March, right? Also large caps, but also small caps. Everyone was scared to put in money. Anyone who asked me at that time what my model said, I told them my model is saying buy small cap. Okay. I know it was extremely hard. I mean, even I would think twice before putting money in small cap after having seen the market do what it did in March. But that's what the model said. That's the beauty of the model. It doesn't fear anything, it has no feelings. The people, very few people actually took the courage to invest at that time. A lot of people took the courage to stay invested rather than getting out. So that was the good part. But some actually took the courage to move assets from large to small at that time. If you look at what small cap has done since then, right, including our own strategy, those are the people who are laughing all the way to the bank. Again, this is not to say every single thing that the model will do will be right. Especially over short term, the model calls can be inaccurate. But as you get more longer term, as you have more history, as you have more cycles, as you have more benefit of wisdom derived from hindsight, the calls start to become exceedingly accurate, more accurate than is possible by making manual calls. That's been our experience, and that's what we saw time and again, including more recently.
And what is model now predicting for next 3 years, 5 years, or maybe next 1 year, if that's possible?
So after the run up, the models become a little less sanguine about small caps. At this, it's sort of saying, look, the good ones have been rewarded amply, maybe a little more than they should have been. The cyclicals would be too tactical a call. There may be a small bump up, but they are not the ones that the model's liking either. So overall, from a very attractive uh, sort of view of the market in March end, right? The model's starting to look at it more neutrally right now. In fact, as I told you, we now do global, right? We look at global markets, more specifically US markets. When the model tries to compare the attractiveness of the Indian and the US market, there's a clear case it's making for having some part of the allocation go to US. In fact, quite honestly, the reason I started the fund, the reason we set it up was primarily starting from my own need to have a structure where I could start to sort of reduce my exposure in India and start to take incrementally more exposure in US. And that's why we set up this offshore fund that we did. So right now, the way it is placed, it's liking high quality, robust companies. It's also liking select financial companies, though there's a risk, as we saw today, right? What happened to the HDFC banks of the world, right? And that will continue to happen. But I would say it's still liking in the large cap. The pharma story seems to be mostly over from the model's perspective. Okay, it's a lot more about IT for the next couple of years. It's a lot more about high quality finance, but with the stomach to stay invested. It's a lot more about very select FMCG and pharma. Okay, and it's about some select infra stories. That's what the model is picking up. It's also picking very selective NBFC companies that are very strongly differentiated. Okay, but what it likes the most are companies which are completely immune to whatever's happening around. So it's liking a lot of significantly attractively priced tech majors outside India right now. Okay. Overall, that's what a global portfolio for me would look like based on the model.
Right. So does your model also cover macro factors like in movement of interest rates or movement of gold or inflation expectations?
That's right.
Yeah. What are the
Uh,
yeah.
interest rate and inflation is extremely important because any kind of valuation analysis of a security is meaningless without taking into account what the prevalent interest rates is or what the risk-free rate is, right? For a lowly interest rate, even a high valuation of an asset class may be all right. Okay. And therefore, it takes into account not just the interest and the expected direction, but also it uses those interest rates relative to its own history to then make adjustments to every single valuation parameter that it uses. And it uses about half a dozen valuation parameters from macros to micros. It does a whole lot of spatiotemporal analysis. It compares every stock in our universe with every other stock. And then also at a macro level, it does valuation in terms of what's happening to the GDP, what was the historical GDP, relative to the growth that's happened, what's happened to the market cap, what's happened to the earnings, what's the earnings beta to the market cap that's likely to happen as the economy starts to recover, and so on and so forth. So some of those parameters are extremely important for the market because it needs to, or for the model, because it needs to take an outlook and a view to what the next few years represents in terms of the attractiveness of the various components of the market, basis which it would then take a more micro view and come down to sectors and stocks.
Right. Finally, one very important aspect comes to my mind. I have interviewed, a lot of fund managers over this, webinar series that we have been doing. And there is one aspect over last 10 years, which if we talk about last decade, equity as an asset class has not performed that well. And Indian currency has got kind of depreciated a lot. And anybody, if it was NRI investor or FI, from their context, they have not made any money. Even from Indian investors' perspective, point-to-point returns of Nifty are hardly like a debt fund. Even they are lower than debt fund or FD returns, right? So maybe partly because this is because none of the fund manager could ever take cash calls, or maybe markets went up, they took beating in 2018, they took beating in 2013, so and now they have taken beating in 2020. So all these events, if fund manager would have taken a cash call, maybe returns would have been superior. But when I ask this question to every fund manager, they give a very practical answer to it, that all equity fund managers are long only fund managers. They have a mandate to remain always invested. They don't have a mandate to ever take a cash call. I cannot take names, but all who's from the industry, right? So they have given the answers, and they have also suggested that if any investor feels that fund manager should take cash call, then he's mistaken, because fund manager is not a god. And they have directed those investors, by giving them guidance, that those investors should go for balanced funds, or they should look for hybrid funds. If they have come to long only equity funds, they should not expect cash calls. But we know, if cash calls could have been taken in the hindsight, returns definitely would have been better. Now, in this entire context, if we say that it's not a human being, right, it's a machine. Now, what will be answer of machine to this particular issue?
So you touched upon a number of very relevant and important points for the common investor, right? It's relevant for all of us. I would say my views have changed dramatically over the years. When we started with this model of ours, because the model was essentially a ranking algorithm, ranking stocks, and always trying to find the most attractive stocks. Therefore, there was no element of cashing out. Right? It was mostly focused on of what's available. Let's find the 10, 20 most attractive ones and deploy our funds there. So we didn't have a notion of cashing out, etc. And we went through the same ups and downs that you're describing. I would say without use of very sophisticated and capable tools, it is not easy to make a cash call. You tend to make errors on both sides. In hindsight, obviously, anyone can look at 2018, 2008, 2013 and say, look, we should have cashed out. The problem is when you were sitting there every day. And in fact, I don't know whether you recall, Kamal, I had once shared a presentation which actually talks about this dilemma. It sort of walks the investor through the experience every day of how the index is moving, and every day how their thoughts change and how greed and fear drives them, right? Every day the market goes down, you feel, look, I've already lost 15%, I would wait for the market to recover and then I'll go out. Okay, that never happens. That 15 becomes minus 20, minus 30, minus 40. You panic, you get out, and within a few days the market recovers fully and you're left out of the market after taking a 40%, right? So therefore I'm saying making cash calls without very suitable experience or tools is a double-edged sword. More often than not, it hurts you because you actually end up entering at the hype peak of the hype and exiting when you should not be exiting at the bottom of the fear cycle, right? So you get hurt both sides. That was our philosophy for several years. But as I said, over the last couple of years, I have personally spent a lot of time researching on tactical allocation as a part of the advisory that I'm developing, right? And I have convinced myself that it's probably a little lazy on part of us to say that, look, you cannot time the market. Okay. Use simple rules. Okay. I'm not even saying you have to use machine learning. Use as simple a rule as look at the last 3 years of GDP or look at the last 3 years of the market returns. Okay. And be a contrarian. That itself would save you significant drawdown. If the market or the GDP has done exceedingly well over the last 3 years, trust me, do this simple thought experiment, do this analysis at your own end for the last 20 years. You'll find that the returns over the next 2 years, once you've made a lot of money in the last 3 years, is in a range which is significantly lower than if you were to enter the market after 3 bad years. There's no doubt about it. Now, is that such a difficult rule to follow? Could one not have done that? And therefore, if something's done really well over the last few years, could they have not gone into more conservative asset allocation? So I'm saying, while it is true that it is extremely hard to make the right calls, if you have some discipline, if you have the right tools, if you have the right data, and you have the conviction to carry out, because what's important is to know that these calls will not go right on day one. You may be off sometimes and off by a few percentages or off by a few days or months. You have to carry that conviction, because if you actually end up reacting too soon, you will get hit on both sides. But with that, if everything's that given, I truly believe now that a very significant alpha relative to the market can be created just by making the right tactical call and the right asset allocation call, the right strategic call. Forget about active management, forget about picking the right PMS or AIF. My data shows that if you were making some of those calls right about being in the market for the right period and being in the right asset class, it beats every fund in every fund category just by doing that. Okay. Now that's something that the industry is realizing gradually. There's a lot more work that's happening on strategic and tactical allocation. It's taking time, but many of the advisors are starting to spend time there. As I said, I have personally spent a lot of time developing, AI-based tools there, the results of which hopefully you will see in the next few months. But I'm very optimistic that in the next couple of years, the industry will change. The industry will have to do a lot of this more, because otherwise the experience is going to be not very different than what it has been in the last 10 years. You see these ups and downs. You can beat the market big time. I mean, forget about others. I look at my own data, right? Each one of my strategies has outperformed the index by a big margin, right? But can I say that those returns were experienced by my clients? Unfortunately not, because they got in at the wrong time and they got out at the wrong time. They didn't last through the entire experience. Okay, how do you control that? As a fund manager, you can only do so much. As an advisor, you can only tell them to be contrarian sometimes. But eventually, when the pressure comes and the investor is really worried and truly worried about, hey, I've lost 40% of my net worth, it's very hard to tell him, hey, this is the time to invest.
Very true. So this is the last question, and then we'll wind up. We have named this entire webinar series as Crystal Gazing: Next Decade of Wealth Creation for Investors. And the name of our wealth management service is AdviceSense Wealth Management. And it's a very successful wealth management service in a very niche segment. And we have named it as AdviceSense because there is a belief that all of us are human beings, and all of us as advisors put in a lot of experience and put in a lot of ethics and put in a lot of effort in terms of advising our investors, and hence we use this word sense, right, over intelligence. We could have said that we are advised intelligence, right? So obviously, the belief is that artificial intelligence can help us become better in terms of our advisory, but at the end, it is a human being whose experience also matters. Purely if we leave everything to machine, maybe, in context of our profession, which is advisory, which is equivalent to a doctor's profession, may not be the best. That is a belief, right? So I am absolutely open to kind of seeing if this belief gets challenged over years, right? So now coming to the question. The question is that today, in this context, so I and all of us in the audience, right, are human beings, and they have been kind of projecting equity markets, and they have been giving this advice to their investors that in long-term equity markets do well over last 10 years. In Indian context, a lot of drivers, whether it be a fall in interest rates, or it be a gap between GDP versus market cap, right, or it be a lot of reforms. All these factors have made the landscape more conducive for equity asset class to perform. And because over last 3 years, broader markets have kind of seen great amount of beating, and the frontline index, if today it's at 11,000, maybe 1,500 points was contributed by only Reliance Industry. So if we see, even within Nifty, there is a lot of value which is still available. You cut Reliance Industries, as maybe Nifty is not at 11,000, maybe it's at 9,700, right? So all these logics, we give to all our clients to ultimately convince them to invest in equity, and at the same time, we also tell them to invest for long term, because equity as an asset class is to be invested for long term, right? So this is our human sense based on our experience. You have human sense based on your experience, as well as artificial intelligence and machine learning, which is backing you. So what would you convey? What would you say to our audience out here who are investors wanting to invest to create wealth, and they also have a long-term perspective? They have risk appetite. Over to you.
Okay. Wow, that's a that's a long question. I would say two or three things. First of all, when you talked about being open to getting challenged by the notion that machines could do better than human sense. As I explained in my presentation, I do not want any one of you to be under the illusion that artificial intelligence has matched or transcended the human intelligence or capability as of today. As I explained, the strong and the super strong, or the sort of the super intelligent phases of artificial intelligence are yet to come. They are probably a decade on the way. Okay. However, AI is clearly able to beat human intelligence in narrow areas of application, given the right data, given the right training, and given the right algorithms. Okay. And so therefore, there will always be scope for, at least for the next foreseeable future, for the human inputs. How you train the model is also a human input, right? You could train the model in such a dumb manner that the AI does nothing for you. So the human inputs can never be overstated. Okay. Now that said, you made a couple of statements about the long term and equity rewards in long term. Well, in long term, all of us are dead, right? As someone said. I think somewhere there's a fatigue setting in, and some for good reasons, right? As an investor, I feel for my fellow investors, we were always told as we were growing up and learning finance, right, and doing our CFAs, that in the long term, equity rewards you better than any other asset class. That long term could be 3 years, then it became 5 years. Now we talk of 10 years. If you look at history, US markets, there are decades after decades where actually equity did nothing. Okay, so what is that long term? If it takes 30 years for equity to beat some other asset class, then maybe the kids would enjoy, but the person's long term's over, right? The most productive years of when he would have or she would have wanted to enjoy the fruits of their labor would have been gone by the time equity rewards. So one has to be a little careful. I would say I have, and as I said, my views I have changed over the years myself, which is from not making market timing calls at all. I'm starting to believe that there is value. I call this the augmented AI approach, where I use AI and I use my own experiences It's not AI is not completely replaced my personal experiences yet. And I have come to believe, as I said, that there are times when the probability of making money in the next 3 years in equity as an asset class are significantly higher as compared to some other period. There's no guarantee, but the probability is in your favor. Okay, and that is possible to do with AI and also with non-AI other quant techniques. AI is not the answer to everything necessarily, right? So we use all kinds of techniques, and then there's experience. Some people intuitively can tell you this is a good time or not a good time, and they're probably right 70% of the times. Who knows? So I'm saying I am clearly not now in that camp which said just keep investing in equity and do not worry about anything in the long term, you will be rewarded. Well, I feel that those times are over. There are a lot of businesses, including the value oriented businesses in Nifty, Kamal, that you talked about, which both my own sense and my model tells me that some of them are actually value traps. They look value attractive, but they are not. They are there for some good reasons. Okay, a lot more polarization is likely to happen as you move forward, because the weak balance sheets are going to get hit really badly. They already are, right? There's going to be a lot of consolidation. There's going to be an issue of survival for many of these weaker businesses, and so it's not business as usual. In good times, the weaker, the value, etc., can do well, but in tough times, usually it's not the value; it's the quality that tends to do better. That's what our experience shows us, right? And therefore, I would be very careful going and just looking at the valuation of the cheaper ones in Nifty and say, look, these are the stocks to buy. I'll be very careful. In fact, as I told you, the model actually likes stocks and sectors right now which are not cheap. Okay. So therefore, it's probably a more balanced approach that one needs to take towards equity. There's no doubt that when equity works, there's not a better class. There's not a better asset class. Gold can do its own thing as it has done from time to time, even a 50%. But it would do it sparingly, right? Equity can do that 50% every few years, but it can also do a minus 50 every few years, as we've seen. So therefore, while the goal cannot be to perfectly time the up and perfectly avoid the bottom or the down, the goal should be to at least try and occupy more of the up and less of the down. I think that's a reasonable goal. And I firmly believe today that with the help of tools and technology that we have, and I'm sure many others have, it is possible to make a call which helps you avoid severe losses. There will be losses, but probably not as bad as one who just sits there, right? Or who doesn't care for the market at all and says, look, I'm just going to continue to invest and stay. There are ways and means to manage that. There's way to do strategic allocation and there's way to do tactical allocation. Both are important.
Right. So we'll just take one question from the chat, box. So and then we will end this session. So you have conveyed that there is a high probability of equity generating fine returns over next decade. And you being an objective man, audience wants to understand if you could put some numbers to it. What is the probability?
Okay. What you have to understand is that let's look at what does the return comprise of. Okay, how does the market decide how much returns should be given, right? Basically, return is a product of two numbers, right? The valuation or the final price is a product of two numbers. What is the present value of all the expected earnings from that company over the next X years, 5, 7, whatever. If the discounting rate is high enough, after a few years, that earnings doesn't matter, right? So because it gets discounted very rapidly. So let's say next 5, 7, 8 years, right? That earnings times what is the multiplier to that earnings that the market is prepared to give determines what is the price today. Simple maths, right? So therefore, the returns that I'm likely to get in the next 10 years for a stock and therefore for the whole market is a function of what is the price today, what will be the price in 10 years. That price in 10 years is a function, as I explained, of what will be the earnings that the market will foresee at that time for the next 10 years, right? Times what it is prepared to pay for that at that time. You see what I'm saying? Today's price is determined by what the market thinks will be the earnings over the next 10 years and what the market is prepared to pay for those earnings. What it is prepared to pay for those earnings is a function of a lot of macroeconomic parameters again. What's the opportunity cost here? If the rate of interest is negative, what are you going to anyway do with that money? So therefore, you are probably going to be willing to pay me a lot more money to get those future earnings because, hey, you don't have an option, right? Or the other way around, where the opportunity cost is too high and therefore you're not going to pay me enough. But that's just telling me the today's price. The return will be determined by the same price 10 years from now. And therefore, what the expectation will be at that time. Now, once you realize what this entails, you know that to give an honest answer to, I feel the next 10 years will give a 16% CAGR is bullshit. The right way to think of this is the asset classes are relatively more attractive or relatively less attractive based on today's numbers, based on today's macroeconomics, based on today's pricing. So rather than saying equity will give 16% and debt will probably give me 6% and gold will only give me 3%, I could say, based on everything that my machine looks at today, the expected returns in equity are probably going to be about the same or within one standard deviation of the last 20 years historical returns, because it is neither very attractively priced today nor very looking very discouraging to me, right? So it gives me a sense for where that return is. That would probably, for example, hypothetically, if it were one standard deviation, it would say maybe the returns for the equity as a class is not going to be more than 10-11%. For a fund manager who has demonstrated that they can generate alpha, 2, 3, 4% alpha, therefore, a particular strategy, whether my own or someone else's, I would expect might be able to do 14-15%, right? But this is all very, very rough, very, very, right? So don't take these literally. I'm just trying to tell you the challenge of giving a number. Smallest changes in macroeconomy, smallest changes in what happens to that earning trajectory over the next 10 years, right? Ask a manager what their company's earnings will be 3 years from now. I've run global businesses. Many of you have. Does any one of you know what your annual earnings will be 3 years from now? Now think about expecting an analyst, a fund manager, or a stock picker to figure out what the earnings will be 10 years from now and then pricing it today and then putting it in the value. Think about it, right? Anyone who thinks they know how it's going to be priced, they are basically just trying to give you their best estimate. I'm not saying anything wrong with that. In absence of something better, something has to be given, but don't take it literally, guys. Okay. So therefore, when you ask me that question, hey, look, I'm objective, I use data, can I tell you what the returns will be over the next 10 years? What I can tell you is I don't know. I personally feel, and my model personally feels today, the next 5 to 10 years return, equity as a whole, it's showing indicatively a range of 9 to 12% as a class. Okay. Take it with a pinch of salt because there are so many things that are going to change every year. 10 years is a very long time. But what I can tell you is I've seen historically an 86% accuracy with a 10-year prediction for this model. I've only been able to backtest this for the last 20 years. There's not enough data in India, unfortunately. But with that limited testing that I've done, it's shown an 86% accuracy.
Right. Thank you so much. So just to add to what you said, to kind of conclude the understanding. Like today we perceive Reliance Industries price as as is at its all-time high. So is it based on that there is going to be exponential increase in earnings over future? So because as you said that the price is determined by how market will perceive its future earnings. In that logic, equity is an asset class. When we talk about the valuations of startups, there also, the valuations are high, price is high because the expectation of future earnings is high. So in that context, right? So if one has to actually build a good equity portfolio for great returns, then maybe forcing those companies which market will perceive to be giving high earnings, delivering high earnings over next 5 years or next 10 years is where the growth will be. Is this what you are trying to convey?
I actually feel slightly differently. Okay, a lot of people say that higher the future earnings, higher the price. Okay, that's a very absolute way of looking at things. My experience shows me, and my model tells me that relative assessment is far more effective in explaining the market behavior as compared to absolutes. What do I mean by that? Think of it like this: which stocks did the best as COVID played out over the last few months? Pharma, FMCG initially, and then IT, of course, telecommunication, etc., etc. A lot of times you will see when the market's crashing, whether it was in 2008, whether it was in some parts of 11 and 13, in 18, etc., you find that FMCG does very well, right? Now, are we saying that when the market is nervous or the economy is going downhill, that the earnings of these companies will suddenly start to grow over the next few years? Obviously, that's not the case, right? What you're saying is the impact of the downside on the economy is going to be a lot less on staples. People are not going to stop buying biscuits just because they didn't get a 10% raise this year. But they're probably going to stop buying a fancy car, right? So discretionaries start to get punished, right? But then why do FMCG start to run up? Their earnings are not going to increase because there is a slowdown. They are probably going to be better than others. Think of this as there is a more or less an amount cumulatively that the economy, the market allocates to stocks, right? Globally, a lot of liquidity is getting pumped, right? Money is getting printed as we speak, right? There's helicopter money being distributed. That money has to go somewhere. The real rate of interest in many countries is negative, as you know, right? Now, where does that money go? It goes and chases companies that look safe in that environment. The valuation is going up for these companies, not necessarily because people think the earnings are going to go up very rapidly. The valuation is going up because they think the earnings are not going to get hit as badly as in other companies. I'm not saying that's the explanation for every single company. I'm saying start thinking relative rather than absolute. Okay. With that, think of which companies or which businesses are likely to do better in COVID and post-COVID situation. Pharma, clearly, there's a lot more spend that's going to happen on healthcare, right? In the short term, even pharma may suffer, right? People are not going to doctors, not to hospitals. There's less consumption of medicine. But by and large, there is a psychological behavioral change that's going to last. And pharma, again, is not as much of a discretionary spend, most of it. And therefore, more safe, more secure. If someone has to buy a medicine, they have to buy medicine, right? Telecom, for very natural reasons, got aligned to this whole thing, right? But more importantly, specifically to your question of Reliance, right? The reason Reliance is getting valued is because for the size, the scale, the resources, the talent pool, the ambition of the founder that Reliance always had, it was in the wrong space. It was in a space which was saturated. It was in a space where there was only so much the founder could have done to grow it. It was in a space where the margins would get not as much defined by the efficiency of the Jamnagar refinery, but as much by what's happening to the Singapore refiners. What's the margin there, right? And therefore, you couldn't be. It was all it's sort of more cyclical, more commodity rather than more differentiated business where you had pricing power, right? Think of what Mr. Ambani has been able to do to Reliance in the last 10 years. He made some very big, bold bets. And if they had gone wrong, believe me, the outcome could have been interested. Believe me, the outcome could have been disastrous. We may not have seen much difference between the two brothers. Okay. He took some really big bets. At one time, if you look at the balance sheet, it was completely stretched, right? People were worried that whether eventually it was going to collapse under its own weight. The reason you see this revaluation happening is for 2 or 3 different reasons, in my opinion. One, the company's changed. The company says, I'm no longer energy. I'm telecom, I'm retail, right? I'm also entering finance. I'm fintech. These are the areas where the new money is chasing. Some of that money is chasing it for the right reasons. The other money is stupid money, which is just following the smart money. In this market, the big becomes bigger. A lot of money is going to ETFs. Reliance has the largest weightage in the index. by definition, billions of dollars getting pumped in from outside because of surplus liquidity, X percent, 12, 13, 14% of that has to go to Reliance by definition because it's passive investment. Now, when all that money by default chases Reliance, what happens to Reliance share? Right? And now you have Facebook. You have potentially other big names, right? You have many such some names, but potentially big names. I don't want to speculate, but there are bigger names which are waiting to enter. Some for their retail piece, some for their telecom piece, right? So therefore, the story has changed from being a traditional, highly efficient, but energy company to, oh, this is a modern conglomerate of retail, telecom, biggest scale in India, one of the biggest in the world, access to resources, the skills of managing the government, managing the authorities, everything, right? I think valuation is a sum total of a lot of that, a lot of liquidity chasing it, a lot of stories behind Reliance. Some of it will deliver, some will not deliver. So usually there's never one reason you could attribute and say, oh, this is happening because of future earnings. Okay. It's happening because Reliance is a different company today. It has the kind of earnings in those sectors which are not going to get moved with crude price. And therefore, the valuation that the market is prepared to pay today is different than what it would pay 2 years ago. Look at Apple, $2 trillion company, right? Last year it was less than $1 trillion. You would argue their market share in terms of units is not going up. iPhone, iPad, right? Every time they have to make money, they have to sell a new device, right? Ever thought about what's happening there? Look at their numbers closely. Look at their services ecosystem. The margins that they get every time someone spends $1 on that game or on buying a service, they get a big cut for zero cost. All the revenue goes directly to the bottom line. And that's a business which is not going to go away. Some people, maybe a few, would look at iPhone and say, it's getting very expensive, let me buy something else. Most of them loyal. Most of them are not going to just buy that phone once in 3 years. They're going to spend dollars every day on those services. That's all free money going directly to the bottom line. So that $2 trillion valuation, which people say is crazy, why do you think Warren Buffett saw value in that? Right? For someone like Warren Buffett to invest in Apple, counterintuitive, right? But he did, because the company is no longer about selling phones. Every year, the proportion of the margins and the profit that comes from services is much more than it was the previous year. That's the story.
Thank you so much, Raman, for such an insightful, interesting, intuitive session. We have done around 20 webinars till now. None of the webinars have lasted so long. And thank you everyone, all the participants, for such patient listening. I think there's a lot to again watch in this webinar. We will be circulating detailed video of this webinar and also writing a lot of content around it, because there was a lot to learn, and we believe in sharing a lot of learning. So for informed investments, thank you everyone for patient listening, and thank you, Raman.
Thank you, everyone. Thank you, Kamal, and thank you, audience, for your very patient listening. I really appreciate the time and commitment you put in today, and I hope you got something in return. Thank you. Bye for now.